Welcome to Drill on Earnings. We have quarterly results from Synopsys. This is the business story behind one stock on a move, and the stock is moving. I'm Cory Johnson, Chief Market Strategist for Epistrophy Capital Research. And Synopsys is such an important company at the heart of designing semiconductors. And of course, semiconductors are ruling the world right now, particularly with AI. So why were the results good and the stock is down? Let's talk about it. So Wall Street just looks at a beat or a miss, and this was a beat. Both in terms of revenues and earnings per share and adjusted earnings per share. However you want to look at it, the numbers were better than Wall Street expected. The guidance wasn't. So let's look a little bit deeper what the business actually did here. So quarterly revenue of $1.636 billion. That's a record for this company, up 11% on a year-over-year basis, higher than the midpoint of their guidance. And their GAAP earnings were better than expectations. Their non-GAAP earnings were better than expectations, up 13% on a year-over-year basis. And this was a fiscal year end for them, so it was a record year for Synopsys as well. So while they're predicting double-digit revenue growth going forward, maybe it's not, when we look beyond the headline numbers, not what Wall Street expected. So let's break down the business. So these guys sell software to design principally semiconductors, but really all kinds of highly complex electronic devices, and indeed that market is growing for them. They're going sort of beyond the semiconductor to the devices that use those semiconductors. They also sell design IP. I think of this as like Lego blocks that are already designed chunks of software that help companies leap ahead when they're designing semiconductors, either from start or just changing the way that they do things. And gradually their business is diversified, so design IP is a bigger and bigger part, but it's very lumpy. In this quarter, the design IP business on a year-over-year basis is only up 1%. They had a fantastic fourth quarter last year, but the trend is their friend. Indeed, the trend is upwards for the design automation business, even though the IP business, I should say, even though it was only up 1%. But the real change for this company, another weird change that happened that affected their guidance, is they're essentially going from a 53-week year to a 52-week year. What those guys used to do was have a design process for their reporting that found the Saturday nearest to Halloween. Yeah, that was a thing. There was the Saturday nearest to Halloween. So you can imagine, at certain points, that Saturday is at the very end of the week. At certain years, it's at the very beginning of the week. And so there could be a 7 or 8 day difference. And indeed, next year we'll have 8 fewer days than the year they're just finished reporting, because they're going to lock it in only on October 31st, no more floating date. But the result is in the first half of the year, they will have fewer days. So when they reported for next quarter, the quarter is going to be a lot shorter. Indeed, the first half of the year is going to be a bunch shorter on a comparative basis. So my estimates had $1.7 billion in revenues for the quarter. They're only going to have $1.47 billion. It was also lower than Wall Street's estimates. And for the year, a little bit lighter than Wall Street expected. These guys are at the midpoint of their guidance, $6.8 billion. I was at 6.9. So a little bit lighter guidance than Wall Street was expecting, than I was expecting. Saw the stock get really hit down 7% in after hours trading. And for the year, the stock was only up 11%. So that really does take a bite. Nonetheless, this business is growing really nicely. And they're caught in this interesting world where AI is driving fantastic growth, but other things are hurting them. Here's Sassine Ghazi, the CEO of Synopsys, who I think really puts a fine point on the tale of two markets.
We are in a tale of two markets. The one that our customers are serving, the AI infrastructure build-out, they're doing incredibly well, and we're benefiting beautifully out of it. These are the companies that they're delivering memory chips, advanced logic, be it a CPU, accelerator, GPU, etc. And that's helping across the board the Synopsys portfolio, the EDA, hardware, IP, etc. But let's not forget there's another cohort, which is the rest of the semiconductor market, the one that they're serving mobile, PC, automotive, industrial. They're still in many ways trying to have a refresh cycle for their products and leverage AI on devices. For us, for that cohort, given we're tied to their R&D, we're still doing fine, but it's not delivering to similar level of growth as the first cohort. So that's from a market point of view. The second factor we took into account is the macro uncertainties. And in here, if you double click on China in particular, the economy continue on decelerate, you layer on top of it the expansion of restrictions that we needed to take into account. Lastly, we're absolutely taking into account and so excited about closing NSYS in the first half of 25 that we need to prepare our company for this massive acquisition, not only the largest for Synopsys, but the largest for engineering software industry. So you take all these factors into account. We decided to guide FY25 with pragmatism and still guiding, as you mentioned, 11.5 to 12.5% growth on the tail of a 15% growth that we just delivered last year.
So pragmatism is the word of the hour when it comes to Synopsys here, talking about this embracing of pragmatism. Grounded in pragmatism was the phrase that they use elsewhere, and I think that's just right for what we got from Synopsys. So we want a summary of Q4 results from Synopsys. We got a quarter that was pretty good. We saw 11% year-over-year growth to $1.636 billion. But the guidance was less than expected. And I think the drill down earnings bite, the one number that tells you a whole lot, is this business really is growing. It was up 11% on a year-over-year basis, 15% for the full year, and the business is doing quite well despite the market's reaction. Thank you very much. All right, thanks for checking out Drill Down Earnings. I'm Cory Johnson. Check me out on X at Cory TV, and please subscribe at Drill Down Pod on TikTok, Instagram, or YouTube.